inflation is actually going up, kind of slow down the Bank of Canada's urgency to cut interest rates. Credit cards rising and auto loans rising substantially for non-homeowners. Almost like a 50% reduction in the expected mortgage payment increase. The youth employment rate just generally worse than the remainder of cohorts. Months of inventory, sort of the highest that we've seen since the beginning of pre-COVID era, and that's sort of like the market that would put us at like the worst price drop in Canadian. House and townhouse rentals are the ones where you've seen the biggest year over year. Up to 75% of people are planning to renovate their home within from this is that 17% of first-time buyers reported missing a mortgage payment, which is welcome back everybody to the monthly market call for Real Estate Magazine. I'm going to quickly go through a handful of things, but I'm going to start with interest rates and then go to employment market because I think that's kind of like the biggest headwind, and we'll talk a little bit about what's happening in different markets across Canada. So first things first, interest rates, kind of an uncertain path right now. So there's speculation that the Bank of Canada was going to cut. Inflation came in. So CPI is down. I'll get to this in a second, but CPI is down, but core inflation is up. And so Bank of Canada typically uses core more as their primary metric. If anybody has questions, by the way, just feel free to interrupt me or just put it in the Q&A, and Courtney can kind of like interrupt me and ask. I'd rather this kind of like be more of a conversation than a presentation, so I'm happy to be interrupted. But basically, like the bond market sort of forecasts what investors who buy Government of Canada bonds think is going to happen to interest rates and like moving forward. And they're relatively high if you look at like the 3-month outlook. If you look at like the 3-year outlook, or like 5-year, 10-year outlook, they're still kind of low, but they're up. And so this will put upward pressure on fixed rates, and it could kind of slow down the Bank of Canada's urgency to cut interest rates. Fortunately, if you go back and look at like historically what the track record of the bond market is when in their ability to predict interest rates, they're not exceptionally reliable. And so, the reality is that the outcome could be the exact opposite of what the bond market's forecasting with interest rates. Oh, a lot of the charts I put in here, actually, you guys can use this thing. A lot of the charts I put in here are from Ben Rabidou's Edge Analytics. You guys are welcome to use this discount code Realist20 for his. He just shared that with me. If anybody wants. So like these charts here, this chart on the right hand side, this comes from his thing. He puts one out on a monthly basis. He does a call like this, I think, on a quarterly basis as well. It's just for realtors and mortgage professionals. So beyond what the bond market expects, the other thing that's worth considering is what consumers expect, right? And it looks like consumers' expectation of inflation is that it's going to increase significantly over the foreseeable future. And so the Bank of Canada is often really careful to temper that, because what happens is if consumers think prices are going to rise, then they spend a lot of money to try and buy things before they cost more. And if they do that, then that actually becomes inflationary. And so inflation can beget more inflation. The opposite happens for deflation, right? When prices are falling, if you're looking for a house, let's say, and you see prices are falling, and they've been falling kind of reliably for the last couple of months, you might say, well, why would I be in a hurry to buy a house if prices are going to be lower in a month or 2 months or whatever? And so deflation begets further deflation. When we look at inflation measured by Statistics Canada through the CPI, so you have CPI, which is the dark blue line here, and then CPI dropped in the last 2 months, but a lot of that came from the carbon tax being removed, which is funny because like we were told for a while that the carbon tax wasn't inflationary or didn't cause inflation, but the now that it's been removed, it's caused disinflation or a reduction in inflation, and so it's sort of I guess ironic that now all of a sudden that it's in favor from policymakers' perspective, it does actually have an impact on inflation, which I think most people would have argued the whole time anyways. But if you strip out energy costs, so basically your fuel costs, and the change in fuel costs, inflation is actually going up. And core inflation is also going up. And so the Bank of Canada is kind of stuck in between a rock and a hard place where, they probably want to keep cutting because unemployment's rising, the economy doesn't look super positive, but core inflation isn't coming down to where they need it to. So they did pause at the last meeting. The expectation is that we would probably see one or two more cuts from them. They have a meeting coming up and then another one next month. My expectation is probably still that they are likely to cut, but I think it's just going to be harder for them, and they're going to be very carefully watching this inflation setup. Similar to inflation expectation, consumer confidence is rising. And this is a big jump up that happened just after the election. This comes from Ben Rabideau's Edge Analytics as well. And I think a lot of that, I think that probably would have happened regardless of the outcome of the election. Just that I think people wanted some certainty on who was going to be leading the country and the direction that we were heading. The Bank of Canada put out a report on the financial sector. So they do this on an annual basis. Financial sector review, they call it. We are seeing some signs of financial stress, but it really is more for renters than homeowners or people who have mortgages, where you can see credit cards rising and auto loans rising substantially for non-homeowners. So the homeowner cohort seems to be a little bit more protected compared to the tenant cohort right now, which is probably good news for the supply situation in real estate. The other piece that I found really interesting in this report that the Bank of Canada put out was regarding the renewal wall. So we've been hearing a lot about how 2025, 2026, the majority of mortgages were renewing in these 2 years. And, early on, we were anticipating payment increases of well, you can see on this chart, 2024, those payment increases were going to be, 15%, basically, that the first blue bar there. Now in 2025, that's come down to an 8% increase in your monthly payment or the average monthly payment of somebody renewing. So almost like a 50% reduction in the expected mortgage payment increase from people who were renewing mortgages in 2025, and even lower, only like 5% increase in 2026. These are your two yellow bars in 25 and 26. So this means that the Bank of Canada has actually done quite a bit of positive work to provide relief for mortgage homeowners who might have had a hard time paying their mortgages if we were facing that big increase in rates and the renewal wall that we were looking at before. From the same report with the Bank of Canada, impaired loans rising in all credit categories, but still super low historically. Like if you look back at the global financial crisis, you can see what a bad market looks like for impaired loans. This is basically like delinquent loans. So you can see business loans in red, consumer credit. So your credit cards in green, residential mortgages in yellow. They're all trending up, but they're still like historically low, right? I mean, we're not even at like 2015 levels, or we're just getting to 2015 levels. A bad situation would be like this 2000, this here is the dot-com bubble, and then your global financial crisis. And the 90s probably would be comparably large humps. We're not even close to that yet. Could we get there? I mean, it wouldn't surprise me, to be honest. But I think that there's a lot. I think that the recourse environment and the leniency almost that lenders have on borrowers right now has really made it easier for that line to stay low, because there's a lot of concessions that lenders have to make, especially with mortgages, for people who can't pay. That makes it easier for them to kind of make that loan whole, or at least buy them some time to like sell their house or something like that. The one chart.
Uh,
Oh yeah, go ahead.
I was just wondering, uh, talking about jobs, there's a lot of talk about whether job losses are going to keep ticking up in Canada. Do you foresee that having an impact on impaired loans in 2025?
Yeah, I do for sure. I think unemployment's going to continue rising for the foreseeable future. I have a whole section on jobs, so I'll save a lot of it for that. But to answer your question, yeah, I think employment and jobs especially like not just job losses, but like the rate of new hiring, because our population is still growing, right? Even though population growth has slowed, it's still growing, and so you get the number of working age people increasing, and so that unemployment rate continuing to rise will have not only a lot of it is like um, you start to worry about mortgages and the impaired loan rate when you start to see lots of layoffs, which we haven't seen a ton of yet. We've seen some, but not a ton, right? Some of the banks are laying off, a couple thousand, 1% of their workforce, whatever. That's where you worry about mortgages. But where I worry more about is the rental market and first-time homebuyer market, because first-time homebuyers are really the ones who push the market up. And what we're seeing is the unemployment rate for new grads and young people is disproportionately high compared to everyone else in the market. And I have a chart on that. But if you look at young people and new immigrants to Canada, their unemployment rates are higher than everybody else, and so those are going to impact, like, that shrinks your first time homebuyer pool, and it shrinks your renter pool as well, from my perspective. Uh,
Okay.
oh, sorry, and in this one, actually, and this kind of answers your question as well. The Bank of Canada put this out. They said a severe and long-lasting global trade war could push the rate of mortgage arrears beyond levels reached within the 0809 global financial crisis. So you can see that level here, but it doesn't look like they expect it to get as high as kind of your 1990s level, which was really the last major correction we saw in Canada's housing market. Okay, yeah, so we'll jump to the job section here. So monthly full-time job growth. This is from the Canadian Real Estate Association. I use the Toronto stats here, but this is really, like, to me, the canary in the coal mine. Toronto's job market's been the worst in the country. Everywhere else seems to be doing reasonably well, and I'll get to like kind of how different markets are bifurcated based on like affordability versus unaffordability. But I think you're seeing negative job growth in a lot of markets now, and that to me is a big point of concern. This is the recent grad stat that I was mentioning. You can see that it's kind of like resumed its really jumped back up to that long-term trend line. So this is almost 2 decades worth of data, right? Since looks like 2005. So it's been a really like long-term challenge that Canada has had. A lot of it because we've been basically, and the Bank of Canada just recently put a report out on this. We've really been growing our labor market through temporary foreign workers, so through like exogenous population growth, rather than through people who are graduating from post-secondary. And so that's why this rate is rising. This to me, again, like, these are the people who might be becoming first-time homebuyers in 5 years, and so you could have some sustained pressure on like first-time homebuyers um, being able to play a meaningful role in housing demand. Um, Study permits were supposed to come down substantially. They did come down a little bit, but they didn't come down as much as the bank, or the Canadian policymakers implied they would, and or actually explicitly stated they would. And so, I was actually pretty like I was like really thinking that big drop in international students and temporary foreign workers would probably have a really severe whiplash on the rental market. And you did see quite a bit of decrease in the rental market, and I'll get to quite a bit of rental market data later in this call, but um, we're still 100% over the long-term average of international study permits. So you are still seeing sustained demand from international students in Canada. Youth employment, again, this comes from Indeed, hasn't really kept up with population growth. So you can see the youth employment rate just generally worse than the remainder of cohorts. Job postings aren't the reason that we've seen a big increase in the last couple of months in unemployment. It is because that the working age population is growing. So it's not
Um,
like more jobs. Yeah, sorry, go ahead.
a question for Daniel. We've got somebody asking, what are study permits?
Study permit is like basically when somebody from another country wants to move here, the type of visa that they get to become an international student. So they're allowed to come to Canada to complete their schooling, and then they're temporary. So they would either apply for permanent residency or apply to be a temporary foreign worker after that, or they would move home. summer job postings are lower than we've seen. So you can see like the market was pretty tight, a little bit lower, but relatively tight to 2024 until we kind of got into the summer. And now there's a big gap in the number of jobs being posted compared to the last 2 years, 24 and 23. Um, and the job market has been weakening for basically 3 months in a row. I'm going to jump over to the supply side now. I hear a lot about like people talking about how, you know, because we've seen this big drop in demand for pre-construction homes, that and people who are outside of the GTA will understand this. Um, you know, in the GTA, people talk about it like because nobody's buying pre-con condos, nobody's going to be building pre-con condos in 25 or sorry, 26, 27, 28. And that'll create some sort of supply gap. But I actually think that the supply gap's being backfilled by purpose-built rental. And you can see this a lot in places like Alberta, well, most of the prairies, BC as well, put a chart out, Atlantic Canada. There's a lot of like rental construction happening right now. And so just because we're not seeing supply that's for sale, like doesn't mean we're not seeing supply at all. And so this multifamily rental supply is supplying the market. We have 250,000 multifamily building permits right now. So we're climbing to like record highs. And I think that the idea that we'll be in an undersupplied market in 2, 3, 4, 5 years is probably just not the case. The market that will be undersupplied is single family, right? So single family housing, like so your ground based single family detached townhouse, etc. So not apartment style is at its lowest basically on record, other than like this big drop that we saw in the 80s recession. So to me, where you'll probably see uh, a shortage of supply is in that single family housing in Canada. And so that market is probably more likely to see a recovery than apartment style housing. Again, going back to purpose-built rental units, this is under construction, so not building permits. We're at a record number and continuing to climb. So you've got basically like between 150 and 160,000 purpose-built rental units under construction in Canada right now. This is a lot of housing. And this is a lot of rental housing. So for investors, this is going to be your competition if you're renting something. And I have some more data on that. This is why we've seen rents kind of coming down and vacancy rates rising. This it when you look at this whole thing, you kind of want to analyze it on a relative basis. So if you look at a market like BC, 15% of their existing rental stock is under construction right now. So if BC had 100 units, they would be building 15 right now. Atlantic Canada is just over 12%. Alberta, still very high from my perspective, just over 8%. Um, if nothing else changes in these provinces, like if population doesn't grow or it stays at the same rate, um, that's like pure injection into the vacancy rate, right? Like those are all units that would, a tenant's going to move from one unit to that unit or whatever, and they're going to vacate the unit. Like this is to me a huge upward pressure on vacancy. So I'd watch very closely what's happening with the rental market and vacancy rates there. The two sources that I use for that are live.rent and rentals.ca. I think they both put out really good regular reports on a monthly basis. So I would encourage people to just like follow along on those. Ontario, in regards to the rental construction, really not all that bad. And so Ontario is probably among the more likely to see this like constricted supply in 27, 28, based on the fact that they're just not backfilling as much of that supply with rental stock.
I see that Alberta and Atlantic Canada are among the regions that have the highest under construction right now. It appears that those provinces might be preparing for more newcomers, more migrants from other provinces, just like they have been over the last 5 years.
Yeah, I mean, Alberta for sure. Like Alberta's got pretty strong population growth coming from interprovincial migration. And that has slowed quite a bit in Atlantic Canada. But yeah, I mean, I think that trend that you're describing is what builders were building based on. So they were saying, oh, well, all these people are moving from Ontario and BC, and let's build houses for them. And then what happens is either like, Ontario prices collapse or the return to work has to happen or whatever, and for some reason that the number of people moving to those provinces slows down, and then now all of a sudden, housing isn't something it's not like a assembly line where you can just shut it off, right? So you finish building them and now you have less demand than you anticipated. And this is why it's very, very hard to kind of master the whole supply thing.
Mhm.
Um, an interesting part with like of just kind of what this looks like is Calgary, I would say, like, kind of describing or along the lines of what you were saying, Calgary had this huge boom of people moving there from Ontario. And I found like what um what happened was you had a lot of this capital from Toronto going out there to build houses and build these CMHC MLS select financed properties. And they were underwriting these projects on in 2023 at like 2% vacancy. But what happened was when all those units delivered in 2024, vacancy had jumped up to 7%. And this is for your brand new supply or newer supply, 2015 plus builds. You can see it has very little impact on older supply, like not maybe not very little, but muted impact on older supply. Um, but you can see vacancy rates jumped up from 2023, the blue bar here, to the 2024, the gray bar, in all across all product types. Um, so this is what happens when you flood the market with supply, right? And so I would say that it would be reasonable for everyone to expect that a trend, something like this, will happen in basically every market where you can see a lot of rental construction underway. Let's skip this one here. That's for Toronto. So residential new listings. The other question kind of becomes like, does resale activity, like Canadian Real Estate Association stats, resale or sorry, new listings, does this kind of count as like supply? And I'm of the opinion that it's not like a one-to-one, because typically if somebody's selling a house that they live in, like if it's resale, they're also going to buy, like they still need a place to live. So they are going to go buy something. And so it nets out. So a lot of people call like residential new listings or active listings right now, record supply, or we're seeing a huge supply flood, but I don't really call that supply, right? It is, but it's not in the same way that new supply is. Um,
That would be a good segue to a question that we had,
yeah.
which is negatively impacting the real estate market more? Is it the first-time home buyers or people who want to upsize?
Um, It's tough to say. I mean, I don't think either are necessarily negatively impacting look. I mean, if we're gonna just boil it down into simple economic terms, the first time home buyer has a higher likelihood of being damaging, let's call it, to the market. Not that like they are damaging, but that they're a less educated buyer. So like somebody who's upsizing has already purchased a property. They're selling a property, so they're not pure demand, right? Because if they buy something and they sell something, then it nets out, right? They're giving a piece of supply to the market and a piece of demand to the market. Whereas a first-time home buyer is purely demand, right? They're just buying a property. But the other thing with first-time home buyers is they've never bought before. So they're more likely to be inexperienced, right? And they're maybe more likely to hire a newer realtor and maybe not get good advice, or be more emotional, or all of these things. And so they can be like, in economic terms, what you might call a less rational consumer. And a less rational consumer can kind of put more upward pressure on price. So that's kind of like the way I would think about that. Um, yeah. Again, going back to this new listings thing, this is like new listings just since 2020, and it would appear that we're relatively high, right? If you look at this kind of just back to 2020. But if you go back historically, like which I went into the Canadian Real Estate Association, their data goes all the way back to the year 2000. Our active listings are, I would say, like it looks like a pretty normal market, to be honest with you. It's kind of less than your historic, like basically that period from '08 to till we came basically into the COVID era, right? Like, but it's um, less than that market, but higher than what you would call maybe a historically normal market heading into uh, '07, '08. Um, this gives us sort of a market balance situation where we've got months of inventory, sort of the highest that we've seen since the beginning of the pandemic, other than those like 2 months where we were in the first lockdown, and the sales to new listings ratio where you've basically got relatively low, right? So we're not seeing a lot of demand relative to supply.
Okay, we've actually got a question here that says, is months of inventory an accurate or valuable statistic for supply?
Yeah, I would say it probably is. I mean, it's the best that we got, right? We have like we basically only have two ways that we can look at supply, right? So we can look at supply through months of inventory, or we can look at supply through or supply and demand through sales to new listings ratio. I mean, months of inventory is somewhat accurate, but the challenge is it can't really capture like let's say for example, a bunch of houses sell in May and then summer starts in June or July, right? And so people kind of slow down their buying activity in June. And so to assume that the number of sales in May like is the denominator, the number you're dividing by for your months of inventory, and to make that assumption that it would hold for the next 3 months or whatever, if we've got, I guess we've got here between about 5 months of inventory. If we've got 5 months of inventory, that really is only true if the next 5 months have the exact same number of sales as the month that we're using. And so it's as accurate as you can kind of get. Sales to new listings ratio is sort of the same thing. It's like, 1 month you get in the spring you get a ton of people listing and a ton of people buying. In the summer you get a lot of those less people listing, right? A lot of those market properties that have been on the market for a while, they maybe been stale, so you're not seeing as much new supply coming on, but people are still buying it up, and so it can kind of skew. Um, but really, like, are they accurate? I think that they're the best kind of metrics that we can use, unfortunately or unfortunately, right? If we go again, like Korea really only gives us these like 3-year snapshots, 5-year snapshots of the residential market balance. So I went into their data set and I pulled all the way back to 88, um, which was sort of the last time that we saw like a major housing correction in Canada. So you go to 89, you saw months of inventory kind of shoot up and stay sort of bouncy in that period through the 1990s when the market was really in a funk and took about like 10, 15 years to recover. You get into the 2000s, you get into kind of more of the market that we're in right now. Not that I expect that us to stay in that market. I think that we probably will see a bit of a spike or outside of this range, but we do seem sort of range bound in this kind of purple shaded area that I put in here, which, the easiest way to think about that is like, just go back and think, if you've been a practitioner for a long time, like, think about what the market was like in, I don't know, like the sort of 2016 to pre-COVID era. And that's sort of like the market that we're in right now, right? It's slow and steady. Where am I? There we go. Okay. I'm gonna jump to the mortgage market now. Uh, CMHC put out a really interesting report on to do their annual mortgage survey. So what they found was there's an increase in people who are paying the maximum price that they can afford in 2025. So we're up from the last 2 years, but not as high as the peak years of 21, 22, when almost 70% of people were paying the maximum price. I did a YouTube video doing like a page turn on this entire thing. If you want to just search my name on YouTube, you should be able to find it. But some interesting stuff, like the number of people reporting that they missed their mortgage payments. This is the other thing that could kind of answer what people were mentioning about first-time home buyers, or the question about first-time home buyers. Like, first-time home buyers also have an outsized impact because they're the biggest percentage of total buyers in the market. So they're 50% of total home buyers. And so if something's gonna happen, or if they do something, the market feels it, right? And this is according to the Bank of Canada. Repeat home buyers are a smaller portion, obviously, because they already own a house, so they don't need to buy another one, right? And investors are the smallest portion. And this is where, again, I don't think investors and repeat buyers are able to have as much impact on the market as first-time buyers. Some interesting stuff from CMHC about first-time buyers from their survey, and kind of take it with a grain of salt because this is a survey, but they basically surveyed, I think it was through 3,500 mortgage consumers. First-time homebuyers were 12% of all people who took out a mortgage in 2024. 56% variable rate, 25%, sorry, 56% fixed rate, 25% variable rate, and 15% combined. 62% of them used CMHC or other loan insurance. The craziest thing stat that I found from this is that 17% of first-time buyers reported missing a mortgage payment, which is crazy. 60% mentioned that they had difficulties maintaining debt payments, and 26% used one credit facility to pay for another.
Do you think that comes down to just the sheer monthly cost of what it takes to make your monthly bills now?
Yeah, I would say so. Like, I think that first-time home buyers are probably just really experiencing financial stress, right? You know, you can you can go and apply for a mortgage and get it stress tested and whatever, but the stress test doesn't really account for um, the stress test doesn't really account for like inflation, increases in my mortgage payment, et cetera, right? Um, and so a lot of those other factors. Robert mentioned I have to compare months properly. I did actually compare in the MOI and in the housing market listings. These are just Q1 data points. So I was using homogeneous data points for these comparisons. Um, your renewers are 65% of your mortgage consumers. So we hear about this renewal wall. A lot of it's just because we had a record number of people renewing mortgages. Um, and so 65% of all mortgages done in the last year were renewals. Renewers missed fewer payments. 12% reported missing a mortgage payment, which is still a crazy number from my perspective. And 47% mentioned having difficulties maintaining debt payments. The refinancers is really the one that stood out to me. 20% of them reported missing a mortgage payment, 63% having difficulty, and 29% of them using a credit facility to pay off another. So a lot of people are refinancing with the intention of consolidating debts. Interesting thing from CMHC's report as well. A lot of people putting secondary suites on their property. 1 in 10 people were planning to, and 28% of mortgage consumers already had one. This stat blew my mind. But the biggest reason is because people would want to use them to cover mortgage payments and expenses.
Now, I know that the federal government has a lot of programs right now to help
Mhm.
people be able to get secondary suites into their home. So that might be contributing to that increase in interest and demand as well.
100%. Yeah. Yeah, they do have the secondary suite loan program and a refinance program, although I haven't heard of anybody actually doing deals through that, but it is in theory it exists. Um, the other piece is that a lot of people are planning to renovate, which this could kind of have downward pressure on supply because people typically are, if they're planning to renovate, a lot of people here are saying, and the majority are saying that they want to customize their home to meet their needs and preferences, which would mean that they probably intend to stay there. The second largest amount is to increase the value of their home, which means that they might actually have an intention of selling. So just kind of pay attention to that stuff. Up to 75% of people are planning to renovate their home within the next 5 years. So, the majority of people are going to fund that from savings, but an increasing portion of people are going to fund that from a home equity line of credit, up from 36% last year to 46% this year. House prices, this is just from Korea, their HPI benchmark price. I did say, I think in the last two market calls that I felt that we probably would see another down leg in price. Does seem to be appearing. A lot of this is really just coming from the fact that BC and Ontario skews the national average down. So it is really like a bifurcated market in Canada. I'll show you kind of what that looks like. So the Canadian national average is down about 4%. BC is down about 6%, and Ontario is down about 5%. And yet at the same time, every other province is up and the national average is down. So that really shows you just how much BC and Ontario can skew the national average down. So it's really a tale of two markets in Canada right now, where you've got basically provinces where people can afford houses, where prices are going up, and provinces where people can't afford houses, where prices are going down. The prices typically return to the mean, which is where people can afford to buy them. And this
So,
is
do the larger provinces, do they act as a forecast or a leading indicator for the smaller provinces, or is it possible that this divergence could just keep continuing?
um yeah, it's a good question. They often can be like a little bit of a canary in the coal mine for other provinces. You just don't see as pronounced of an effect. Like Toronto definitely led in 2022 Q1 the drops, and what you saw was, I mean, during that period, like a lot of people, there's two ways that this can kind of impact it, and I'll give you the positive and the negative. So the negative is like you would see a wealth effect, right? So you'd have a negative wealth effect. So if people are making money in Toronto, but the market's too inflated, they go to start buying or investing in projects in Calgary or whatever. So that was like the kind of positive wealth effect. If Toronto prices drop and they have to maybe sell some investments there to free up some cash, then it has a negative impact on the Calgary market, let's say. But the other thing is like you could also see a flight to quality where people want to go to more stable markets, right? So if Toronto is too volatile or too unaffordable or whatever, maybe people just say, I want to get off this roller coaster and I'm going to go put something in like a blue chip area that hasn't really seen too much volatility in price. And they go to a place like a Calgary or Atlantic Canada or whatever, where those, had historically been less volatile. So it could really go either way, to be honest with you. I would say that the easiest way to think about it is looking at like the prices relative to income in all of those markets. So like Calgary, I mean, and this actually conveniently, like this is a chart about this. So mortgage payment as a percentage of household income. And you can see like Calgary and Montreal are relatively they're unaffordable compared to what they were, during the pandemic, but they're far more affordable than the Canadian average and Toronto and Vancouver. And remember, the Canadian average is skewed very high here based on the Toronto and Vancouver stats. But what you can see is there is an improvement in affordability in Vancouver, Toronto, Calgary, and Montreal. And a lot of that's coming from interest rates coming down and house prices coming down.
Mhm.
Um, the national house price decline that we have seen right now from peak to trough, so from your 2022 Q1 peak to present day, is about 16%, which would put us at like the worst price drop in Canadian history. That on record. We don't have data from the 80s, but 80s might have been worse. This to me is like one of those things like, so many buyers are afraid, right? Or they're sitting on the sidelines or whatever. But typically, like as prices come down, there's less risk below you and there's more upside potential below above you, right? And so you get people piling into the market when it's going up fearlessly, yet the risk is increasing as prices grow. And now that the risk is decreasing as prices fall, there's nobody to be found that are lining up. What's the reason for this? Well, it was kind of that deflation thing that I mentioned at the beginning. If people think prices are going to fall, they're just going to wait for lower prices, right?
Mhm.
I'll go through rents quickly here as well. This is from rentals.ca. So you can see rents falling in a handful of markets. Alberta, because of, I would say, increases in supply. BC, the same thing. Ontario, rents are down substantially. Same thing, a lot of supply coming online. Um, and you can see on a city by city basis, Calgary rents are down over 10% uh, on a year over year basis in April. Um,
So, um, like we were talking about earlier about new housing supply, would you suspect that rental prices would be under more pressure when some of this new supply all comes online?
Yeah, they should. I mean, all things remaining equal, unless the population outgrows new supply, which it should, right? Like we have, I think your immigration number, like permanent residents, is about 400,000. That's the new revised number, plus all your non-permanent residents, so like temporary foreign workers, student visas, etc. Your population growth is still probably going to be like, I don't know, 5 to 800,000 people, and we only have 250,000 rental units, being built or contemplated. And so, you could see it'll soften the impact of that. But I think eventually we will get back to a growth scenario in rents just because we have more demand than supply, right?
Mhm.
Um, Canada seems committed to growing our economy by through population growth, and so I think that eventually we'll get back to a growth scenario. If you look back, I think we're now in our seventh consecutive month of annual price decreases in rents, but you can see that they're shrinking in their severity on a month over month basis. So uh, yeah, I think like a couple more months and we'll likely get back to the point where we are seeing rents kind of moving up again. You can see that if you look at the 3 month change in average asking rent, you can see that we're actually back in the positive after spending quite a substantial period of time in the negative. And a
I
lot of
know.
this you can see. Sorry,
Oh,
go
I was
ahead.
gonna say, some provinces are now starting to loosen up or delete their rent cap policies that were put in over COVID too. So
Yeah,
that provides a boost there as well in certain provinces.
yeah, for sure. Yeah, totally. Um, the one of the reasons why we're kind of seeing this like slowing of rent decreases is you often see rents jump up in from April to May in most markets. Like just this a lot of leasing activity and like this, like call it summer bump in the industry. You in Toronto, we didn't see that last year for the last 2 years, but you did see it again in Toronto. This chart comes from live.rent. And you saw the same thing happen in Vancouver, where it basically flattened, where coming off of a relative downtrend. And so you are seeing rents, like I'm always reluctant to use this term, but I would say the worst is probably behind us for rents. But that doesn't mean that it's over, right? Like it doesn't mean that they're going to stop falling. It just means that like the majority of the pain has already been realized. And so, like if we've been experiencing about a year of pain, there's probably, there could be, as long as it's less than a year, the worst is behind us, right? So I think that a lot of this has already kind of come out in the wash. But the interesting part here is that you see is house and townhouse rentals are the ones where you've seen the biggest year over year drop in rents. And yet those are the markets that are, you go back to that supply scenario I was mentioning earlier, those are the markets that are most undersupplied. Um, by province, you can see Saskatchewan, so the Prairies, Saskatchewan, Manitoba are seeing growth in rents as well as Nova Scotia. Everywhere else is seeing rents falling. Um, yeah, I think that's everything I have for today. But happy to do any Q&A if anybody has any questions for me.
Hmm. Any indication of the latest on how the tariffs are affecting the markets? I know that the prices of materials are going up for building due to tariffs. Prices are going up every day. But it seems like with the election behind us that people seem to have a little bit more confidence in what's going on in Canada. We at least know who our leader is now, and who
Yeah.
is going to be dealing with Donald Trump. Just wondering what you're hearing on the tariff front, in this
Yeah.
past.
Um, It seems like I think people are kind of like just it's old news, right? Like I think the election's done. I don't think people are as concerned about it. I think like you've seen, and not to say that they shouldn't be, because I think that like a trade war is probably gonna have even if like the trade we forgot about the trade war, I think the damage of it has kind of been done in such that like there's not like a high trust environment. You can see this in the US bond market right now. I think that like um there's a lot of more like longer term economic consequences that are going to come from like what just happened, and those will come out in the wash. um I think if anything it kind of just gives the government less to blame. Like everybody's sort of just been blaming the US for like what's wrong with Canada's economy or whatever, but the reality is we had the writing was on the wall here for Canada for a long time. And I think that the it just gave us a good scapegoat um with the trade war. So I think that I honestly it does feel like a lot of that's kind of behind us. I think that they've kind of backed off on Canada. It seems like they've got a target on the EU right now. I'm not really sure what the whole objective of this whole thing is, but it seems like it's not a forefront issue for a lot of buyers right now. I think buyers are more concerned about like unemployment, what's happening with interest rates. Like I think employment is really the one that's going to drive everything. Nobody's going to buy a house if they don't have it, if they're worried they're going to lose their job, right?
Yeah, for sure. Did you want to talk about the event that you have coming up on Friday,
Oh
the
yeah.
A It's real estate event?
Yeah, let me pull up a page for you. Um, yeah, so we have a event called AI Meets Real Estate. It's sold out in person, but we do have online tickets available if anybody wants. And I believe there's a discount code for REM. I might have to get you to email that out though, Courtney, because I have to get it from my marketing guy.
Mhm.
But yeah, so if anybody wants that, just let me know. I think the online tickets are only 25 bucks anyway, and it's just a Zoom. Like you'll be able to join a Zoom, and yeah, every other ticket's sold out, but you'll be able to join a Zoom and kind of tune in to get the content there. Let me just see if I can get the discount code now. I don't know. Yeah, but I guess I'll just email it out. Can you'll be able to email everyone? Yeah.
I'm
I'll get a
sure
link.
that,
I'll get a
yeah.
link and a discount code for them to send to everyone. I just don't know if David from my marketing team has it yet.
Great. It looks like we've just got some question from somebody wondering if you'll be sending out the charts.
Yeah, I'm happy to. Like if somebody wants the deck, I'll send you a copy of it, and happy to. I think you guys post this on YouTube as well, right? So they could just take
We
screenshots
do.
from there. That might be the easiest way to get them. To be honest.
Okay, great. Well, that looks like all of the questions there.
Okay, amazing.
Great.
Cool.
Well, it was so
Well,
nice chatting with you, Daniel.
yeah, likewise. Thanks everyone for your time and tuning in, and hope to see you again next month.
Okay. Bye, everyone.